Hello again, everyone. I am Mr. Darston, and welcome once again to another edition of In the Money with Mr. Darston. We'll be continuing our series on indices that should be on our watch list. Today, the index we're going to focus on is very synonymous with the term Wall Street itself, and that is the Dow Jones Industrial Average. You'll see, much like the S&P 500 index, it is a very reliable, old school index that you too can invest in. The Dow Jones Industrial Average, or simply the Dow, as it's otherwise known as, is a price-weighted measurement stock market index of 30 prominent companies listed on stock exchanges in the US of A. The Dow is one of the oldest and most commonly followed equity indices, and it is, unlike the S&P that we discussed previously, a price-weighted index as opposed to a market capitalization weighted index. Now, a price-weighted index is a stock market index where each constituent company or stock makes up a fraction of the index that's proportional to its component trading price. What this means is more expensive stocks have more influence on the index. So, in a real-world example, that would mean that a stock trading at $100 per share would make up twice the total index value of a stock that traded at $50 per share. The Dow has been around for over a century, as it was created by Charles Dow, who was the editor of the Wall Street Journal and co-founder of Dow Jones and Company, and he named it after him and his business associate statistician Edward Jones. You may have heard that name before. Edward Jones is a widely known money manager as well. Now, the word industrial came to the name of the index initially because it emphasized heavy industrial sector stocks or companies. But over time, stocks from other companies and industries came to be added to the Dow Jones Industrial Average. Although the Dow has been around for ages, it is not considered by many to be an adequate representation of the overall U.S. stock market, especially when compared to broader indices like the S&P 500, which has 500 companies represented, while the Dow only has 30. Those 30 companies include many household names that most of us are extremely familiar with. We have companies from AT&T, Bank of America, Chevron, Coca-Cola, Disney, ExxonMobil, Johnson & Johnson, Microsoft, and many others that we typically frequently buy products from or have a service from on a daily basis. The Dow has been around for well over a century, and over the last 100 years, the Dow's annualized average return has been about 8.5%. What that tells us, according to our old friend the rule of 72 that we mentioned in the S&P 500 video, is that an investor in the Dow stands to double their value every 8 to 9 years. After learning about the Dow and considering the very reputable companies that make up the index, many investors and potential investors are asking themselves, how can I invest in the Dow Jones Industrial Average? Well, if you're one of those potential investors, let's get to it. Now, the Dow Jones is not a vehicle you can purchase or own shares of directly. It's a measure and not a purchasable vehicle itself. So in order to participate in the Dow, you need to buy into some vehicles that track it or its components directly. As an investor who's looking to get in on the Dow, whether you want to be an owner of it proportionally based on the weighted average or just on the individual stocks that comprise the index, there's a few ways you can approach this. Let's get into a few of those. Number one, you can buy shares of the 30 individual stocks in the index outright, owning each company individually. Secondly, and this is perhaps my favorite approach, you can buy index funds or ETFs that track the index directly. Another very popular option that's been around for quite some time now has been to buy in on the so-called dogs of the Dow. They're the 10 highest yielding dividend stocks that comprise the Dow Jones Industrial Index. Owning shares of each individual company proportionally has been quite expensive, and for someone who's just starting out, that may not be the best way to go. That's why the dogs of the Dow strategy has been so popular for so long. That would mean instead of owning all 30 of the companies, an individual investor would own the 10 highest dividend yielding stocks. They're listed here. As I stated earlier, my personal favorite way of investing in the Dow is through an ETF that's ticker symbol DIA. This ticker symbol represents a trust that seeks to achieve its investment objective by holding a portfolio of common stocks that are included in the Dow Jones Industrial Average, with the weight of each stock in the portfolio substantially corresponding to the weight of such stock in the Dow Jones Industrial Average. So basically, it mirrors the Dow. This Dow mirroring investment is my favorite because you can get into it with right now less than $500 because the share price is in the $400+ range. You do not have to buy 30 different companies proportionally in order to participate in the Dow, because this is a way to shortcut your way into being proportionally invested in the Dow Jones Industrial Average. In conclusion, to each of you who's taken this walk down Wall Street with me, I want to say thank you. I hope this has been enlightening and you've learned to appreciate what the Dow Jones Industrial Average has done historically, and more importantly, what it can do for you as an investor. If you have more questions, please log on to www.mrdarston.podia.com and enroll in our Money Mastery courses. I look forward to speaking with you all again soon. Bye bye now.